BRRRR is the most talked about real estate investment strategy out there, but it is also the one that most investors get wrong. The idea is beautiful in theory, right? You buy distressed, you rehab it, you rent it, you refinance, and then you repeat. You recycle your capital forever. You build a portfolio with almost no money down. In 2026, the theory itself still works, but the execution is going to be harder. The LTV limits are tighter, the DSCR qualification is stricter, and the deals where BRRRR actually pencils out are a narrower slice than they were 5 years ago. But when you find one and structure it right, BRRRR is the fastest legitimate way to build a rental portfolio in America. In the next 9 minutes, I'm going to walk you through the complete BRRRR playbook, what it is, when it works, the hypothetical numbers on a real BRRRR deal, and the mistakes that kill refinances at the closing table. I'm Robert with OpenLane Funding. Let's get into it. BRRRR stands for 5 steps. Each letter matters, and skipping any of them will break the strategy altogether. First is buy. It's going to be B, right? You buy a distressed or underpriced property that's typically 65 to 70% of what it will be worth after the renovations, or ARV. That's usually through a bridge loan, a hard money loan, or a fix and flip loan that allows a refinance exit. Then you have your first R, which is rehab. You renovate the property to a rentable condition, and ideally and beyond, to force appreciation, right? You got to have appreciation. The rehab creates the equity that makes the refinance work. Then you have your second R, which is rent. You place a qualified tenant on a 12-month lease. This is required. Most DSCR lenders will not refinance a property without a signed lease, and in many cases, verified rental income. Some even require on the appraisal to make sure that the tenant's there. So it can't even be a new lease agreement. It has to be a lease agreement with evidence that the tenant is living or moving into the property. Your third R is refinance. You refinance out of your short-term rehab loan into a long-term DSCR loan. And you pull cash out at 75% LTV based on the appraised after repair value. This is the step that recycles your capital. Your final R is you repeat. You take that capital that you pulled out from that cash out refinance and you deploy it into your next deal. Physically identical to the fix and keep, but what separates the BRRRR is the cash out refinance and what you do with that money. 4 types of deals where BRRRR reliably pencils in 2026. Deal type 1, a heavy value add with forced appreciation potential, not cosmetic, structural, or functional obsolescence fixes, but you're adding a bedroom, you're converting a garage, you're finishing a basement, you're splitting a large single family into a duplex. Your appraisers, they're going to pay for square footage and bed and bath count. The bigger the delta between your all-in cost and your appraised ARV is, the more that 75% cash out actually returns. You have deal 2, a small 2 to 4 unit. Now, these get appraised on both a comp basis and a rent basis. Lenders are only going to use as disclosure the comp basis. They're not going to use the income basis for value add, but it's good to know. The renovate rent raises, rent raise, and the appraised value climbs on both metrics simultaneously. The strongest BRRRR profits in 2026, hands down. Why is that? I didn't have this prepped up in the script, but why does a 2 to 4 unit pencil better on a DSCR loan than a single family? More units. The more units, the better you're going to pencil on the cash flow. Sometimes in certain areas, what happens is with these interest rates, you run into a cash flowing issue on your properties, right? So you get a single family, say in certain areas of, say, like New Jersey, where you're paying $500,000 to $600,000 for this home. Okay, your cash flow on that, you're going to need a really big monthly payment, right? That's what you're going to get with the DSCR. So your rent's going to have to be even higher or equal. You don't want it to be equal. You want it to be more than your monthly payment so that you have money to set aside for incidentals, right? So a 2 to 4 unit, at that point in time, you have more opportunity to have a smaller incremental increase on the rent from what it would be for a single family. So it's not as big, right? So you're charging, say, $1,500 a unit. That's going to be a lot easier to obtain a bigger DSCR loan than it would be for a single family, because you're charging, say, 4 tenants versus just 1 tenant. That 1 tenant's going to pay a lot more money, right? Deal 3, submarkets with real appreciation momentum. You need the neighborhood ceiling to support your ARV. If you're renovating in a market that's flat or declining, the appraisal won't hit the number you need. Growing submarkets to do the heavy lifting for you. And here's the thing. If this happens, and it's been happening a lot more here lately, especially in the Sun Belt, right? Texas, Florida, Georgia, all of those areas right now that have declining markets. And Florida's and Texas and California, they're all getting hit hard. These investors at the beginning, they're getting into a loan. You get the original appraised ARV, and what's happening? You go into the DSCR, now your value comes in low, right? That 75% that you're penciling, well, now you gotta have to bring cash to close if you want to exit out. Or you can sell a property and make profit that way. That's where the 3 to 1, the video I did before this one, comes in handy, right? That's where you have to shift sometimes on your strategies. But there are markets, and right now it's pretty much the Midwest and Northeast sections of the United States where there's not a lot of building, but there's employment coming in, right? You want to pay attention to that. Follow my Facebook. On my Facebook, I do, weekly updates of where the best markets are to invest in. If you have questions, reach out to me directly. I have a lot of answers. I can get you what you need and what the market that fits best for you and what your strategy is, or what's closest to you. Sometimes, hey, this is the closest market that's appreciating right now. Deal 4, deep discount acquisitions. You have auctions, you have off-market deals, motivated sellers who that need to close fast. Generally they're getting foreclosed on. Off-market deals are going to be a great, go door to door. There are softwares out there that you can pull so you can look at they call it title, but it's just a quick, hey, this is how much they have a mortgage on it, a couple years back. Or First Dam has a good report as well that you can pull. That's very detailed. That goes into how many mortgages, when, and all that, if the information is available. But when your buy price is at 60% of the ARV instead of 70, the whole refinance math, it's going to change. Now, if you buy at 60, your refinance is at 75%. Okay, you got 15% of cash equity you're pulling out. So the better you find a deal, the better you're going to be doing. These deals are rare and they require operational hustle. You got to get out there. You got to door knock. You got to talk to these sellers. You got to have to go to title companies. You have to go, like I said, go find a My First Dam account and go door to door. Okay, this house looks distressed, driving for dollars, right? That house looks like it's run down. Oh, I'm going to pull a My First Dam report on it real quick. Oh, hey, you know what? Looks like they owe about $92,000. Oh, but you know what? Right here it says it could be an out-of-state owner. Oh, okay. Well, maybe you go to a title company. Maybe you find public records. Track this guy down. Okay, hey, Mr. BRRRR, I know that you're based out of Chicago. My property's in Memphis. Do you want to sell this thing? It's pretty ran down. Well, there's a lot that you can do. Even going to title companies, finding, properties that are in pre-foreclosure. Those are great ways to find great discounts if you want a motivated seller trying to get out of his properties. I'm way off script here, so I'm going to jump right back into it. What generally doesn't work are going to be cosmetic only rehabs, cookie cutter properties in flat markets, premium finished properties at neighborhood ceilings, and any deal where your all in cost is going to be above that 75% ARV. Those are going to be more for the final deal, say on that 3-in-1 method that I talked about, where it's 3 flips and then 1 keeper. Those are going to be for the keeper, right? But that's not going to be for the first 3 deals or a BRRRR method. Doesn't work for the BRRRR method. Now, let me walk you through what the BRRRR numbers, right? These are all hypothetical for illustration purposes only, but we're going to find a 3-bed, 2-bath property in a submarket with growing areas. Cleveland's one of them. Actually, St. Louis is another really good one. Comps say the ARV is sitting at $400,000. Your purchase price is $220,000. Your down payment on that is going to be about 10% through a short-term bridge loan. So you're looking at $22,000 down plus closing costs, right? Your loan amount is $198,000 at roughly 10.5% interest. Your points for origination are going to be 2, so you're sitting at $3,900 for that. Your rehab budget will say is $50,000. Closing costs are generally run about $4,500. Depending upon where you go, title companies, there's all sorts of variables that when it comes to run to that. Cash into the deal at closing is going to be about $30,500. Mind you, you also need to keep reserves. So, I'd say a comfortable area for jumping into your first fix and flip is going to be about 40 to 60 grand in reserves, because you're going to need but that's before you start the deal, right? Because you're going to need to get into the property. You're going to need to pay that $30,500 down payment. Okay. Well, you have reimbursement draws. You're not going to find a lender out there that's going to be feasible for new investors. That's going to not do a reimbursement style draw. Okay. Now what? Now you close on a property, you just spent $30,000 down. Now what are you going to do? Now you have monthly payments. Some are non-Dutch, and some are Dutch interest, depending upon, right? So your interest only payments could be cheaper in the beginning. Well, okay. Well, now you still have to get your contractors paid to get them working. That's why reserves are crucial. You never want to enter a deal where you have $35,000 and you're paying $30,000 at closing. That is setting yourself up for failure. Lenders that require reserves, they're not looking to ruin your deal. They're looking at protecting their assets, which in return protects your assets. Because the last thing you want to do is put $30,000 down and then lose everything in a deal that goes sideways. Same with appraisals. Don't fight it. Value doesn't come back. Deal wasn't meant to be. Some things are just not worth fighting for. That's why setting yourself on the contract side is crucial. Make sure you hit your inspection within the inspection period. Make sure your EMD is soft. It's not hard up until your inspection periods are over. Make sure you have a reasonable inspection period time frame. Make sure that it's not your EMD is not $50,000. If it's your EMD is $50,000, if you can't afford to lose that $50,000, stay away from it. A reasonable EMD earnest money deposit, you're looking about $500 to $1,000, maybe occasionally up to $1,500, right? But if you're starting to get into wholesalers or sellers or realtors that are trying to get more, I'd take a step back, because if you can't lose that money and continue what you're doing, I would stay away from that deal. Deal's not right for you. Okay, let's jump back into this. I keep going off my script and I'm losing my track. Let me walk you. Okay. Yeah. Okay. We got that. Okay. Here we are. Rehab spend is $50,000 paid in draws from the loan amount. Holding cost during the rehab, interest, taxes, insurance, utilities, about $12,000. So cash into the deal during the rehab, you're $12,000 more if you're paying holding out of pocket. Total cash into the deal by the end of month 5, you're looking at $42,000 to $92,000, depending upon how the rehab was funded. Most rehabs are going to be reimbursement style draws, so you're probably going to be on the lesser side of that. but you never know. You could have held back for 50 grand, open up the walls, and here's another 15 grand, right? So it could be anywhere between there. The rent phase, months 5 through 7. Place a tenant at $2,600 a month on a 12-month lease, 2 months of collected rent while you wait for the seasoning of $5,200. Okay. Now you continue holding costs during this window. Now you get into your refinance phase, months 7 through 9. You got to find a good lender. You got to start the process. DSCR lenders, a good reputable lender. You can get some that close fast, but some do close long. They have, so make sure you budget for time frame into that window. But your appraised value comes back at 400. Maximum cash out is 75%. That's 300,000. Now you pay off your existing loan at 248 after your rehab draws. You have closing cost and points about $6,000 on the refinance. So cash out, you're looking about 46 grand. Now, after the refinance, the new loan balance is 300,000 at DSCR rates around 7.25. All hypothetical, depending upon rates and where the DSCR rate actually covers, we can get down to about 6% right now. New monthly payment about $2,000 principal and interest, plus taxes and insurance. Going to be case by case. Yeah. If your rent's at $2,600, your net cash flow after expenses is about $150 a month. Now you recovered approximately 46 grand of that around 92 you had, but you still have about 46 grand trapped into the deal. Now you own a cash flowing rental with about $100,000 of equity into it, and you can deploy that 46 grand into your next transaction. That's a BRRRR that pencils. It's not spectacular, not the no money down version that the YouTube gurus have out there promised, but a real capital recycling that builds a portfolio over time. And one that does pencil out, it's going to look close to this. You're not going to have a massive spread on rent. Most are going to be breaking even or really close after you have your principal, interest, tax, and insurance. A lot of investors, a lot of gurus leave out the taxes and insurance. You have to put that into the equation. Now, I'm going to take a quick pause because if you like the content that I'm doing, hey, make sure you hit that subscribe button, hit that follow button. If you comment BRRRR Playbook below, I'll send you a full execution, right? For a checklist that I use with my borrowers. Make sure you hit subscribe because next week I'm going to do a deep dive into the buy and hold turnkey investing and for the strategy for the W-2 professionals who want to be invest in real estate, but guess what? They don't want to be project managers. So 2 requirements that most YouTube BRRRR videos skip. Both can kill your refinance if you're not ready for them. Refinance or requirement 1 is seasoning. Most DSCR lenders require 3 to 6 months of ownership before they'll refinance based on the ARV instead of the purchase price plus documented improvements. Now, some lenders require 12 months. If you try to refinance too early, you're capped at your original purchase price for LTV calculations, which destroys your strategy. Or there are lenders say that it will require all of them, right? So the main requirement's 12 months, but they allow 6 months. Okay, well, guess what? Now you have an LTV reduction and you have an interest rate hike. Okay, wait, hold on. Well, that same lender will allow you to go to 3 months. Well, guess what? Another interest rate reduction. But hold on, or another interest rate hike. But hold on, now your interest rate doesn't cash flow. So guess what? Now the loan amount has to come down to make sure the property still cash flows. It's a dangerous cycle. You got to make sure you're shopping out there for these lenders. That's why individuals like myself, I have about 150 different lenders in my pipeline. So I can help you find the lender a lot faster than what you can generally do yourself. And I have established relationships to make exceptions. Now, make sure you talk to your DSCR lender before closing on your purchase. Confirm their seasoning requirement. If it's 6 months and you finish in 3, you're waiting 3 months for the clock to run. Make sure you budget extra holding cost into your underwriting equation. In reality, the majority of rehabs are going to take 3 to 7 months anyway. Now, requirement 2, DSCR qualification. Your refinance loan has to qualify based on the property's income covering the new debt service. Minimum DSCR ratios are sitting at 1. Most lenders even want to see 1.15 or better for the best pricing. Some are even at 1.25 for best pricing. Here's the math on our hypothetical. Now, your new loan at $300,000, principal and interest around $2,047. Taxes, insurance, HOA, if any, let's say $400 a month. Now your debt service needs to be around $2,400. Okay, well, your rent's at $2,600, so put your DSCR at 1.06 in that ballpark. That qualifies for most lenders, but barely. Better pricing would require higher rent or slightly smaller loans. If your DSCR comes in below 1%, you can't refinance at the LTV that you wanted. Either you have to take a smaller loan or you have to wait for the rent increase or pivot to a fixed to keep at 80% rate and term instead. 4 mistakes I see over and over that break the DSCR at the closing table. Mistake 1, rushing the appraisal. Your entire refinance depends on the appraised ARV hitting your projected number. Do not schedule the appraisal until the property is 100% finished and photographed as a rental in showable condition. No half-installed cabinets, no exposed drywall in the garage, no half-landscaped yard. Appraisal is great on what they see. And sometimes if you're in one of those appreciating markets, sometimes it does help to wait, 9 to 12 months before getting it started. Mistake number 2, no rental comps prepared. Bring the appraisal a package. Recent closed sale comps for the ARV plus rent comps on the DSCR side. You're not influencing the appraisal, you are informing it. Most appraisers appreciate the effort and it prevents low value surprises. Now, they most likely won't use what you gave them because they can get in trouble, but it'll show them your target area. And then it'll help them, okay, this is a little bit less work that I have to do. So they'll try to target where you're at. Mistake number 3, bad tenant placement. Placing a below market tenant to fill the property fast destroys your DSCR. A vacant month costs less than a bad tenant at low rent or for 12 months. Wait for the right tenant at the right market rent. And it matters more than you think. I have some borrowers that want this BRRRR method. This is their preferred strategy, okay? But they also want to be good tenants of, of what they're doing. So what does that mean? What I'm meaning is they're trying to keep, their rents low for people because they're trying to help out, disabled vets or whatever it is. And that's a great cause. I'm not shunning what you're doing, but you have to reset your expectations. If you're charging, well below market rent to help that, widowed wife or the disabled vet or, the abused mom, whatever it is, it continues to go down the cycle. But if you're doing that, you're not going to be able to hit that 75% DSCR loan amount and ratio. So you have to be able to adjust what your strategy is for what you want. If you want BRRRR, you have to hit that market rent. I understand. Maybe you do the 3-in-1 rents or the 3-in-1 flips. So you do the 3 flips, 1 keep, and that 1 keep, that's where you get it. Going off track. Okay. Mistake 4, underestimating the timeline. Realistic BRRRR timelines run 9 to 12 months from the purchase to refinance, not 6. Rehab takes longer than planned most of the time. Tenants placement takes 30 to 60 days. Seasoning requirements add months. Refinance itself takes 30 to 45 days. Budget holding cost for the realistic timeline, not the optimistic one. So make sure you're budgeting properly. Not every attempted BRRRR should stay a BRRRR. 3 signals to pivot. Signal 1, appraisal comes in low. We've already talked about that. If your appraised ARV lands below your projected number at 75% cash out, shrinks proportionally. If the cash out doesn't recover enough to fund the next deal, take the 80% rate and term instead, or just take a rate and term. Sometimes you're not going to get 80% and be a rate and term. Sometimes it's going to be lesser than that. But if you go less, you also get an interest rate reduction. So generally about every 5% LTV you drop, your rate gets better, which means you get a better payment and you accept that some capital stays in the deal. Signal 2, DSCR comes in tight. If the 75% cash out, we already talked about that as well, right? Puts you in your DSCR below 1 or even right at 1, you are one repair or vacancy from a payment problem. Take a smaller loan at 70% or a pivot to a rate and term at 70% with a lower rate that improves your DSCR. Signal 3, market softens during the rehab. If the comps deteriorate during the rehab projects, what happens, your ARV appraisal will follow. Rather than fight the strategy, adjust. Move to a fix and keep with a rate and term is often the smarter outcome anyway, when the market's soft. The strategy serves the numbers. The numbers do not serve the strategy. Watch my fix to keep deep dive if you haven't already, because most BRRRRs in 2026 actually quietly become fix to keeps anyway. And then it saves you an early pivot. Bottom line is this. The BRRRR method still works in 2026. It works on a narrower set of deals than it did 5 years ago, or even though it used to do. It requires better execution than it used to. But when you find the right deal and run the playbook right, it's still the fastest legitimate way to build a rental portfolio in America right now. Heavy value add, small multifamily, growing submarkets, deep discount acquisitions. Those are the deal profiles that pencil today. Make sure you comment BRRRR Playbook. I'll send that over to you with an execution checklist that I use for me and my clients. If you got a specific property that you want me to help you underwrite, make sure you let me know. I can help adjust the offer right. I can do a lot of stuff. I could run feasibility reports on the value. I can run feasibility reports on the potential rent. Make sure we're adjusting as you need it. Hit you on the right market. Phone number to reach me at is 208-215-9936, or you can go to openlanefunding.com. You can see everything there as well. I'm Robert with OpenLane Funding. I'll see everybody on Friday. Thank you.